Welcome back to the OMB Law Board. I'm Simon Bennett, partner at OMB Solicitors, and today I've got Sandra Koschel, Senior Manager at Findex Advisory,
Accounting and business advisory.
Accounting and Business Advisory. Thanks for the jump in there.
That's all right.
Sandra, thanks for joining us today. I wanted to have a good chat to you today about structuring. It's something that comes up for me all the time, and I work in conjunction with Findex and other accountants a lot to get the structuring right for investors or people setting up a business.
Yep, it's exactly right. So look, I could talk all day about structuring and tax because I really like it, but I'm going to do sort of a brief 101 of structures today, right? So I'm going to talk about maybe 4 main structures.
Okay.
But firstly, why do we structure and what do we mean when we say structuring? So pretty much we're talking about if I want to invest in some shares or buy an investment property or indeed start a business, I could just rock out and do it in my own name. Okay.
Yeah.
That's a sole trader. But we like to structure away from that usually for 2 reasons.
Okay.
One is asset protection, and the other one is to save tax or tax minimisation.
So I know from a lawyer's point of view, we're all over the asset protection, and from the account side, you're all over the tax.
We are all over the tax,
and that's why we work together on this stuff, right?
That's exactly right. And we do a lot of cross-referring, with you guys. So they're the 2 reasons. So asset protection, of course, means if I went out and I wanted to start up a business, okay, a marketing business, say, and I just go do it in my own name, and you know, everyone has good intentions, but if something unfortunately fails, okay, the business doesn't go as well, the market crashes, who knows? Any debts that are out there with creditors and whatnot, if I don't have any structure in place and it's just me, myself and I have my home that I live in or other assets, then everything's up for grabs, right? There is no separation between the business and my personal assets. So that's what we mean by structuring asset protection. So if we're doing these things, starting a business, buying investments, it's important then to look at that. The other, of course, is...
I'm just going to jump in there because people often see an individual or a business which has gone under, but then they see these people still having heaps of money and heaps of assets.
Yes.
And that's because of structuring, right?
Yes, that is exactly right. That is structuring. Now, look, there is some shonky, particular industries where the tax office are all over that. Like if they do it time and time again and they leave all these people hanging dry, that's called Findex activity. And they've got a task force for that. But generally, if we structure correctly in the right way, and it's not intentional.
I quite often think about the dominoes sort of in a a physical sense, is that if you've got 3 different businesses and they're different dominoes and they're all in the one entity or structure, if one of them goes down, the whole lot falls.
That's right. So we'd put them in 3 different structures.
3 different structures.
That's exactly right.
So we can have 2 successful businesses and one, unfortunately, that didn't make it.
That's right.
That's really sensible.
So that's asset protection. The other issue, of course, is to save tax. If I have a really successful business and I'm doing it as a sole trader in my own name, okay, all tax is taxed to me. There is no scope for sort of spreading it around. I'll talk to more about that later. But if my income is over 180 grand, it's taxed at the highest marginal rate, which is 47% in Australia.
That's high.
Right, we're high, yes, we are, but we enjoy great rides and hospitals and stuff like that, right? And I always say to people, well, look, if you're making money, you're going to save, you've got to pay tax. But our job is to minimise.
So that's the key phrase, isn't it?
Not tax avoidance, tax minimisation.
And I want to get this right. We're talking tax minimisation here. We're not talking about any non-payment of tax. We're just using the systems.
Using the laws, within the laws. But if people don't know the laws, that's why they come to us as specialists, then you just don't know. So they're the 2 reasons to structure. So the first I'm going to go through are sole traders, partnerships, companies and trusts. So first, just very quickly.
Right.
Okay. So a sole trader is like the example we just touched on, right? It's just me, myself and I get an ABN, I'm registered for GST and out I go.
Away you go.
Yeah, away I go. That's a sole trader. Do we see many of them? Probably not. Like we generally don't advise it for all of the reasons that we just said before. But a lot of people, they start out, they're having a crack, they might do something on the side while they're still working. So they just start that way.
Advantages, low cost to set up.
Exactly.
There's no setup cost
That's
really.
right.
And
not high accounting fees and all that sort of stuff. Okay.
But not many benefits.
No, not really.
No protections.
No, not at all. Now, why would you do something in your own name? First of all, your main residence. So the property that you live in, okay, is generally structured in your own name.
Principal, place of residence.
Exactly.
Yeah.
Because when you sell it, you won't pay capital gains tax on your own residence, as opposed to like an investment property that you go buy. Okay.
Yep.
So if you bought your main residence in another structure, like a company or trust,
Yep.
it would attract capital gains tax. So
Got
there is some instances where you do want to put some stuff in your own name.
Okay.
The other reason may be for negative gearing purposes. And everyone sort of hears negative gearing, but don't fully understand it. So if you went and bought an investment property and you rent it out, and that rent is income, but all the expenses relating to that property exceed that rental income, like interest and rates and all that.
So we're losing money.
It's a loss. It's in a loss,
Yep.
right? And it's done that way on purpose. You can then offset that loss against your salary and wage income, right? And that helps for tax.
So we can minimise our tax.
That's correct.
And use some of that money to pay down our investment.
That's exactly right.
Fantastic.
So that's another reason you would do that. Aside from that, generally we don't see much going on with sole traders.
Right. Okay.
Yep. So then there's partnerships. Now, we generally don't advise just you and me together go into a partnership either, because it's just two individuals then splitting. But you can have partnerships of trusts and other things more complicated. But other than that, we don't see partnerships very often.
Right.
And they have this thing of, joint several liability.
Right.
Yeah.
So
you're with partners. Yeah.
I'm liable for your debt and you're liable for mine.
If we go into business, you're my friend, I trust you, you go out and rack up all these debts, even if I didn't know about them, I'm not just responsible for my half if it's a 50-50 partnership, I'm responsible for all of them.
Yeah, so we've got to be really careful.
Yes,
eh?
we do.
Okay.
Yeah, we do. And then there's companies and trusts, and they're probably the most common ones that we deal with, okay?
Right.
For business owners, for investors, property developers, you name it. So companies are different. They are a taxed entity themselves. They are separate from you.
So a separate legal entity.
Yep. They have their own tax file number. They will lodge a tax return separate to your own. So they are taxed themselves, generally at 25%. Yeah. Forever and a day it used to be 30%, but over recent years, the government's been dropping that down. So 25%.
Well, this is sounding better than 47.
That's exactly right.
Okay.
That's exactly right. That's a big difference. And that's a flat rate.
Right.
Okay. So individuals go through brackets of tax rates. So a flat rate, 25%, which is good. And from an asset protection point of view, we have this idea of this corporate veil. So it's separate to you. That's sort of what we call it, right? That's my funky corporate veil move.
Right. I love the corporate veil. Yeah.
It's the corporate veil. So what that means is, look, if I go out and I'm doing my business, I've got suppliers, I'm buying things, I'm trading, and things go bad, okay, generally, I'm personally not responsible, right? That's very important. I'm personally generally not responsible. Unless, of course, I've given personal guarantees, okay? Which, let's face it, if you're leasing, hiring, banks will often require it for finance.
So we've got this corporate veil, right? And what it does is it protects the individuals in the company from the debts of the company.
That is correct.
But there's a few exceptions, and you were just jumping into one.
That is one of them, and the tax office is increasingly over the years we see expanding what the directors are personally liable for.
Okay, so personal guarantees.
Yep, and then it used to be sort of just that. And then the tax office are all over, like you said, people just go under, staff haven't been paid super. So now directors are personally liable for unpaid staff super.
Super guarantee.
That's correct. They are responsible for, when you're working for someone, they will withhold tax from your pay. You get the net pay and they ship that off to the tax office.
Okay.
Unpaid pay-as-you-go withholding.
Good.
Director's responsible.
Right.
And now the most recent one, GST.
GST. Wow. So there's a number of things that can pierce the corporate veil. I'm going to add one to that list is if the company is trading whilst it's insolvent, the corporate veil is also pierced.
Yes.
But we've got some seriously good asset protection there.
Other than that,
and we've got some tax advantages.
Yes, major tax advantages, yes. And of course, trading insolvent is, you're going and buying something and you can't pay that bill when it's supposed to be paid. That's trading insolvent. Okay. And that's ASIC hates that one. That's their bee in their bonnet. Like severe penalties for that one. Yeah. But other than those things, most people are just doing the right thing. So generally, for all other debts of the company, you're not personally responsible.
And we quite often see that. Someone going and setting up a business, a company's quite a good structure for a business startup.
Yes.
Yeah.
Yes, it depends. So it depends.
On what you've got.
Yeah. So a company is separate to you. So you might think, okay, well then how do I get paid? So you can be an employee of your own company, just like all your other staff, pay yourself a wage, compulsory super, just like everyone else, 11% at the moment, going up to 11.5 at 1 July. So that's been increasing over the years. It used to be 9% ages ago. I think it's going up to 12% over the next couple of years, superannuation. Or you can take money out a loan from the company to yourself, or the company can pay a dividend. So with a company, just like, big companies like Telstra or whatever, you have directors and shareholders. So directors run it, but they don't own it. The shareholders own it. So it's very important, even if you have a company, to get the right advice, because again, we may not want you to be a personal shareholder. We might want you to hold your shares in a discretionary trust or something else. It's probably best.
So getting that advice up front as to how you would structure a company, if that is the right structure.
Oh, yeah. Who's going to be the directors? Who's going to be the shareholders? It's not just simple. You really got to get the right advice. Yes, that's correct.
So I think that company's got a lot of advantages.
It does, it does.
What about the trusts?
Well, I'll just say one other thing, which is a disadvantage before I move on to trusts, is that they do not enjoy the 50% capital gains tax discount.
Oh, yes.
Okay,
this is a big one, hey?
Yeah, and sometimes this is often a big decider between a trust and a company. So it depends on what you're doing. So in Australia, and it applies to individuals too. So if I own an investment, a share, an investment property, and it goes up in value, and I've made a capital gain, if I've held it for more than 12 months, I will only pay tax on half.
50% tax-free?
That's right.
Ooh.
Companies don't get that.
Beautiful.
They just don't get it. So then we move on to trusts.
Okay.
So trusts are completely different, right? Very common in Australia, but very different to companies. They don't pay tax. They are not a taxable entity. They will lodge a tax return, but it says, right, this is my income. This is where it's going for tax purposes. So it doesn't actually pay tax.
And who's this down here? What are these people?
Well, it depends. So you have like unit trusts. I'm going to talk the main two types, discretionary trusts and unit trusts. Yep. So like with the company, you have fixed entitlements. You might own 50 shares, I'll own 50 shares. We're 50-50. So you can do that with trusts as well. Maybe in a unit trust. So you'll hold 50 units, I'll hold 50 units.
And that's fixed.
Fixed.
So we set, I'm going to get 50% of the income, you're going to get 50% of the income.
That's it.
Good for
non-related parties.
Yeah, non-related parties getting into business together.
That's correct. That is correct. Together. And then half goes to me, half goes to you, and then you deal with your own sort of tax affairs.
Okay.
The most common ones really, though, for like a family business, or just one person, it's more likely a discretionary trust.
Okay.
So it's called discretionary because there's no fixed entitlements. It's at the discretion of the trustee every year where this profit is split. And it can change from year to year. And indeed, that's one of the things that we are doing right now before 30 June is tax planning.
Yes.
Is looking, okay, where is this going to go this year? Okay. We're giving advice on that.
So the trustee can determine which of the beneficiaries or the class of beneficiaries is going to receive a distribution or a payment based on a number of factors, including your tax planning.
That's exactly right. Okay. That's exactly right. So we're looking around at everyone's taxable incomes. They can, of course, distribute to a company and enjoy that 25% rate. There's just a lot of rules around that. I'm just keeping this simple, but it can distribute out, but there's rules around that. And trusts can enjoy the 50% discount as long as it's not distributed to a company.
Excellent.
Companies can't.
So therefore, the benefit of the trust over the company is in an investment where you make a substantial capital gain.
That's right.
And I'll just talk numbers because I quite often do this exercise and say, if you make a capital gain of $100,000 and you've got to have held a property for 12 months to enjoy this tax-free 50%. Out of that $100, let's say, that you make as a capital gain, if you don't get the benefit, you're going to pay tax on the full $100.
That's correct.
If you're an individual or a trust, $50 straight in your back pocket, tax-free.
Half of it,
done. And I'm only paying tax now on the $50.
And there's no threshold to that.
That's amazing.
We could be talking millions of dollars. So there's no threshold. So
we need to think carefully about that.
Yes, we do.
Okay.
And what we're doing, are you buying a property to hold long term? Are you a property developer? Capital gains doesn't apply anyway. You're in business. Okay. So structuring is important. You need to get the right advice. So
good asset protection through the trusts.
Yes.
Both fixed and discretionary, similar to the company.
Yes.
Okay.
Yes. So look, the only other thing is if you've done it wrong, if you stuffed it or you didn't get advice, which we do see, can you fix it, right?
Right.
So you might have started out small, now things are growing, right? Or we just see someone that just wanted to get going, didn't get advice. So yes, you can. You can. It's best to try and restructure, right? Get advice and do it earlier rather than later.
Before the value goes up.
That's correct. Because when you restructure, say I was a sole trader and I want to be in a company now, it's a sale, and it's a sale just like a sale to the market at large. And it must be done at market value. So people go, can I just sell it to myself for $1? No.
Yeah.
There's market value attribution rules. The tax office are all over that.
We've got stamp duty,
capital gains, and stamp duty.
Transferring assets across. Yep.
So it's better to do it earlier than later. However, there are quite a number of rollovers and concessions for a restructure.
I like the sound of this.
Particularly into a company. So a rollover is, I've made a gain. Let's just pick it up and roll it over into the company and defer it until a subsequent sale. But there's a lot of different rollovers, a lot of boxes to tick, but you can do it and still possibly pay no tax at this point.
Okay.
If you get the right advice.
If you get the right advice.
The only other thing I'll mention is that's not the same as buying a property. You've really got to get the structure set up before you go to contract. Otherwise, you can have double stamp duty. So, we always say, if you're going to buy something, come and talk to us first before you sign on the dotted line.
Yeah, and we deal with that one here a lot, particularly in the property law team. The request to put Simon Bennett or nominee on a contract and all this sort of stuff. It's just an absolute no from me. It's a massive warning. There's risks of double duty. Get your structure set up first. Speak to your accountant, speak to your lawyer, find out if it's in a trust, find out if it's in a company, put that name on the contract because, stamp duty is painful enough, right? I don't want to pay it twice.
No, and we're the same. I think back in the day, you used to be able to get away with or nominee and change it. It really just doesn't fly anymore. So we never recommend that. No.
Fantastic. So I think we've got some good options here. We've got a sole, to recap, we've got a sole trader, often, a startup, low cost, but not a lot of protections, not a lot of benefits.
No.
We've
main
got
residence,
principal place of residence, capital gains tax-free. We've got your companies, which are a bit more complicated, but they certainly give us a lot of protection.
Yes, and they do need to have their own tax return and financials done, like a trust. So yes.
So we get a lot of protection out of them. And then we've got the trusts, and we've discussed two different types. We've discussed the fixed one where it's locked in.
Yes.
So for non-related parties, where you know what you're getting. But then the family or discretionary one where you can decide come tax time where's best to put the money.
Can change from year to year. Exactly right.
And would your advice be, to get that advice up front, get these structures set up before you start doing things?
Yes, definitely. Definitely. Because, and particularly if you're going to go and buy a business, which is really more common than starting one from scratch, honestly, really, these days, it's just like buying a property. It's a purchase contract. You really must have it set up beforehand. Yes, you do.
And tell us how Findex can help with that process when they come to see you or get on the phone or shoot you an email.
Yeah.
How do you guys sort of deal with that?
We want to meet, and look, we do it, an obligation-free meeting, but we really like to help clients from the very get-go, right? From starting a business, making money, protecting the money, passing on the money. So, superannuation I could talk about all day. We don't really have time, but that is another structure. You know what I mean? So it technically is a trust structure, but we can certainly help. We do all those advices. We do the tax office registrations. We do the company and trust setups for you. So we get it all
full
set
service.
Up. Yes, we do. Yeah.
Full service. And full disclosure to our listeners and our watchers today, Findex are my personal accountants. And, one of the reasons why I work so well with you and a number of your team members, because you are full service.
Thank you.
Like OMB.
We are. And we're all around the country too.
Yes.
Yes. And New Zealand.
Well, Sandra, it's been really informative and we've learned a lot today. I'm sure our listeners and viewers have learned a lot. Probably a heap of questions to come out of this, and we may need to follow up with another episode at another time digging into detail. But thank you so much for your time and informing us of the different structuring and what's involved.
It's my pleasure. I really enjoyed it. Thank you, Simon.
And to all our listeners and viewers, stay tuned for the next episode of the OMB Law Board. We look forward to having you back then.